Welcome to Funding Juicy Solutions, where I talk about mortgage strategies and tips. In this episode, I don't get too much into guidelines as much as I do explain the relationship between Fannie Mae and Freddie Mack and the lending industry. So take a peek. So Fannie Mae and Freddie Mac are private institutions that lend money on the secondary market, which is a whole nother episode, that are guaranteed or insured by the government. And so they have guidelines that a borrower has to meet if they're going to lend out the money on that loan. Now, a bank is going to meet those guidelines, and if a borrower comes in that does not meet those guidelines, say they have a 600 credit score, or their debt to income, they only make $3,000 a month, but they have $2,000 of credit card debt or a car loan or whatever, then their debt to income is at 75% or 66%, whatever it is. They won't qualify for that loan, and the bank won't give it to them because the bank cannot turn around and take that loan and sell it to Fannie Mae and Freddie Mac because that loan doesn't qualify for those loan guidelines. Does that make sense?
So the bank could do whatever they have the money to do, but most banks, I guess it's just important that they're able to sell it to Freddie Mae and who?
Fannie Mae and Freddie Mac.
Fannie Mae and Freddie Mac.
There's another one called Ginnie Mae. You're retired Army, right?
Yes.
So VA loan is a Ginnie Mae loan because it's a government loan. Fannie Mae and Freddie Mac are, private money.
And why is it a big deal that they're able to, that they want to sell it? Is it just...
That's a really good question. So, if anyone can loan money out to anybody for whatever interest rate or whatever terms they want, but that money is in the hands of the borrower so long as the borrower has not finished paying it off yet. Now, a bank, like you said, they can lend out, they don't have to follow the guidelines, but if they have, say, $50 million out on 500 different loans, well, that money is stuck being lent out to those borrowers while those borrowers are repaying that loan back. Now, if they have an opportunity or whatever situation, it could be...
Everyone wants to draw the money out of the bank.
Right? Yeah. If they want to loan that $50,000 out somewhere else, well, they have to get that money back. So what they can do is leave that loan in place and go to Fannie Mae and say, hey, these 500 loans, they meet your Fannie Mae guidelines. So I will sell you these loans at a certain rate, and then Fannie Mae will buy those loans from the bank because they meet the guidelines that Fannie has set.
The bank has a cash to do something.
Exactly.
Okay. So
that's why it's important for a bank. I mentioned before, they're very conservative institutions because there's always a risk when you lend money out, right? You never know if you're going to get it back. But if you've got someone that's willing to buy the loan, that mitigates your risk some more because you have another outlet to get your money back.
Got it.
As you can see, Fannie Mae and Freddie Mac loans are like a safe harbor for any lender that's going to lend out money on a home mortgage. And since banks have a lot of money and they're very conservative with that money, typically they're going to only loan out money on the guidelines or the terms which are required by Fannie Mae and Freddie Mac. So the broker advantage in this case is that there are a lot of lenders that will lend money out on different terms, looser guidelines that don't meet Fannie Mae and Freddie Mac. A bank will not broker a loan with a lender like that because they use all of their own money. Therefore, a broker has access to those options. Remember, whatever your situation, there's a juicy solution waiting for you. Give me a call if there's anything I can help. I'd be more than happy to take a look at your situation and see what we can do.